How many situations in your personal life do you have policies in place? Think about your family policies, and what about your work policies? Yet how many of you have ever outlined your investment policy? Today we will discuss some big reasons why you need an investment policy.
Welcome to this episode of Plan Your Wealth with Purpose, Principles for Investing and Wealth Creation, with Wealth Creation's education and tax coach, Jim Fisher. James Fisher is a registered advisor offering investment advice through Signature Investments, Inc., an SEC-registered investment advisor, Dayton, Ohio. James Fisher CPA and Wealth Creations is unaffiliated with Signature Investments, Inc.
Webster Dictionary defines policy as wisdom in the management of affairs, a definite course or method of action selected to guide and determine present and future decisions. So with that in mind, do you think a policy that helps guide your decisions regarding investing for your financial security is important? Yet how many of us have ever worked with an advisor that helped formulate a policy? The last couple of weeks we discussed the 3 rules to investing and why they are traditionally so hard to maintain. And then we outlined 4 myths destroying your portfolio. Not following the rules and instead following the myths is a direct result of not having an investment policy. Risk exposure, asset classes, and rebalancing would all be part of your policy. Let's first look at what happens if you don't have an investment policy statement directing rebalancing. Let's say this is an example of an imaginary stock market. So the market is going along fine, and then wham, it takes a significant drop. Without any structure or roadmap, many investors, as well as advisors, will tend to panic and get emotional at this time and start to sell off the portfolio and move into different asset classes such as cash. Then later, the market starts to rebound, and eventually, people start feeling more comfortable and re-enter the market. What they've actually done was sell low and buy high, the exact opposite of what we're supposed to do. We're supposed to buy low and sell high. Why not utilize the forces that the market has instead of going against them and fighting them? What I mean by that is when the market starts dropping, as I mentioned earlier, professional advisors and investors sometimes get emotional and start selling off their holdings. Why wouldn't you have a policy that utilizes the market forces and dictates that you buy when an asset class is going down? This has 2 distinct benefits. First, when it goes back up, you own more. Would you rather have 10 shares that go up 100% or 20 shares? Second, your risk tolerance stated in your investment policy will dictate your correct mix of assets. Without rebalancing, swings in the different asset classes will change your risk exposure, which will lead to unmet expectations and bad behaviors and bad returns. Put it all together, creating and following an investment policy will lead to a much more peaceful and pleasant investment process, simply because it will dictate the 3 rules of investing, and you will be eliminating stock picking, market timing, and track record investing. And you will be eliminating the emotions. If you would like to create a better investment process and experience, please connect with me on my website or give me a call.
Thank you for watching this episode of Plan Your Wealth with Purpose with Jim Fisher. For more information, visit wealth-creations.com. Also browse the other shows found right here at Toledo Biz TV Shows.